Hi everybody, we're going to continue our discussion of the reducing balance loan sheet, and if you want to know how to set up one, there is another video that helps you see that clearly. But this time, assuming that we have set up the loan sheet for a principal of $8,000 at an annual interest rate of 6% and a loan term of 36 months, we are going to find out how we can set up a one-time payment and percent of interest paid overall to take this up one notch. Let's scroll down quickly to the bottom of this loan sheet just to confirm that at the 36th month, the principal or balance at the end of the month is indeed zero, as we expect, if everything is programmed correctly. So it's possible to pay a big lump sum, big or small or whatever amount, anytime during the duration of the loan, and that goes into reducing your principal directly. To do this, let's set up a column to the left of the loan balance at the beginning of the month. It's very easy to set up a blank column. Select the cells that are relevant and right-click, insert cells, shift right. So this shifts the entire set of cells to the right, and the formulae are all transposed correctly, and so you will not have any difficulty. So in this column, let's title it as one-time payment. So that's done. And now let's choose any month, say August 2021. Let's write down $1,000 here, saying that you paid this money in addition to the minimum monthly payment. Now, what's remaining is that we need to include in the formula for the portion paid towards the principal for this month, this value as well, using a simple addition function. So that's done. You can see that the portion paid towards the principal now goes up by $1,000. Make sure to copy this formula upwards as well as downwards by clicking and dragging, so that you could enter the one-time payment in any month and it would still give you the correct balance. You see that the balance at the end of the month has also reduced by $1,000, thereby reducing the starting balance of the next month to $5,344.24. Let's scroll down and see how this affects the final results. It looks like we have some negative values here, which simply shows that the loan has been closed earlier than 36 months because we paid an extra $1,000 in between. That quickly reduced the debt to zero, but because we didn't set if statements to correct that, you have negative balances here. Now, so when we go to the next level, we'll see how to set up if statements to set the negatives correct. But for now, we just need to find the percentage of the interest against the principal. Now let's look down here. This appears to be the sum of all the interest paid for all the months. However, you note that there are some negative values of interest that come through as well. We do not want to have those values included in this sum. So we want to click here and make sure that the sum is just up to the last positive interest value, which happens to be this cell, which is F36. So we're going to sum this from the top, which is F6 to F36, hit enter, and that appears to be the interest that's accrued, over the term. So let's go up here and set up a few cells to talk about the overall interest paid. So note that we have set up two new cells here, total interest paid and interest as percent of the principal. The value that you see here has simply been referenced from below, from F42, the cell that we just saw that showed the sum of all the positive interest values. And the last thing to do is to find the percent of the interest against the original principal of $8,000. Use simple knowledge of the percentage expression, right? It's the interest divided by the loan principal and that whole fraction multiplied by 100. Let's do that now. So using that formula, you get the interest as 7.77%. Note that this interest is more than the stated annual rate of 6%.